Hello and welcome to this week's edition of the Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, and joining me in the studio is the co-founder, Tim Kulhanek, and partner, Jeremy Gove. We've got a great show for you today. The title of today's show is How to Detax Your Retirement. And really, this is a part two. We did a similar show not that long ago, got such a great response, so we wanted to continue the conversation today, and we are so glad that you are here with us. Tim, Jeremy, this is going to be really fun doing a part two. Talk about what happened after we aired the first installment of How to Detax Your Retirement.
Chaos.
No. The best kind, right?
The best kind. No, we got a huge response for people who saw the first show and they're like, oh my gosh, this had never been brought to my attention. Mm-hmm. The fact that we're kind of sitting on a growing building ticking tax time bomb with some of these pre-tax retirement accounts. I need to do something about it. A lot of people go into stonebridgetaxbill.com to check out that free calculator. We're going to hit that again today, so stay tuned. But yeah, it was a great response, and so we thought, it's like an encore presentation here.
For sure. Well, and Jeremy, I'm curious, when folks have come in to meet with you as a result of that show, what's been the biggest aha or the biggest takeaway for them?
Well, I think they just realized right away that it's something that they should have been thinking about for a long time, right? That's the aha moment. Why didn't we talk about this?
Or why didn't my current advisor talk to me about this, right?
That's exactly
a better point,
Yeah,
exactly.
a better point. And the CPA, whoever's doing their taxes, why aren't we talking about that? And so, we'll talk about a lot of those different things in this show, but it's as Tim said, it's been kind of chaotic with a lot of people coming in, but it's been good because we're making a big impact. So that's what we're here for.
And helping change lives for the better. That's what it's all about. So again, this concept of how to detax your retirement, yes, you're hearing us correctly. Similarly, we are always told how we should detox our lives from harmful substances. Well, we know that taxes can be one of the most harmful substances in your retirement. So we want to help you know how to remove them. A lot of folks aren't even aware that that's a possibility, right? Which is why we've got to talk about this. But again, for folks who maybe didn't catch that previous episode, everyone, if we continue this with this analogy of detoxing, right? A lot of people are headed into retirement with what we call a tax hangover. Yeah. Can you explain what that actually is?
Yes, tax hangover. It doesn't make your head hurt. It might, it probably should, right? You don't need the Tylenol so much, but the definition of a hangover is something that remains from what is past. And so, many of the topics we cover on the show, they're focused on retirement. And really, I think today's show is relevant to anyone who plans to retire in the next, ever, right? Because it's something we're all going to have to be faced with is, for years, people have believed that they'll be in a lower tax bracket once they're ratired, right? Yes. That was the common wisdom, common knowledge, all told.
Yep.
And I think for a lot of history, that's probably been true. But I don't think it is anymore. And for a few different reasons, the biggest being the fact that, if you look at what the government brought in fiscal year 2024, I think it was something around, $4.1 trillion or something like that. Well, or $4.9 trillion. They spent 4.1 on mandatory programs alone, right? Social Security, Medicare, Medicaid, and then they spent another $800 billion, this year over $1 trillion, on interest, the debt service. So every penny the government's bringing in is taken up before we get to fund any of the three-letter agencies, the FBI, the CIA, the DEA, the DOD. There's no way to actually provide any of the services really beyond Social Security, Medicare, and Medicaid that so many Americans depend on without taking on additional debt. And eventually that debt has to be paid. The bill comes due, and where does the government get the money? By tax revenue, raising taxes. So I think we're in a very vulnerable position as retirees that might not be true anymore. We're in a lower tax bracket in the future, so we need to be prepared. And an update from our last show, as of December 31st, 2024, total U.S. retirement assets are now stand at $44.1 trillion with a T, yes, trillion dollars. And it's believed that around 75 to 90% of those dollars have never been taxed.
And guess what? The government knows it, right? And they are wanting to get their hands on it. And so this is the thing, right? I think we're taught too that there's only two certainties in life, right? Ben Franklin said it, death and taxes. Well, we can't control death. And when you group those things together, people think, well, then I have no control over my taxes, but that's just not true, is it?
Right, exactly. I think that's the challenge. When we sit down with people, it takes a little bit of time to re-educate them because they come in thinking, well, my income's going to be lower, my tax bracket will be lower, so I won't pay as much in taxes. So many retirees, they're coming into retiring, I guess, and they're realizing our taxes aren't going down. And we can actually illustrate that for them in the software that we use. So taxes, anything that you're drawing out of your retirement accounts that's tax deferred is going to be tax as ordinary income. When you add that to Social Security, investment income, and other income sources, that can help push you right back up into a higher tax bracket.
For sure. And there are some additional areas of taxation that come into play in retirement that folks haven't had to navigate previously. So we need to touch on those briefly. First up, taxation on Social Security.
Yeah, it's a real curveball that's thrown into a plan, because the reality is when Social Security was written into law in 1935, I think it was, I think FDR said, today the hope of many years standing is fulfilled, right? Well, that hope has somewhat faded as folks have realized that, oh, this benefit I thought was going to be tax-free, oh, now I have to pay taxes on it. Surprise, I don't know if this is a shocker for you, but yes, your Social Security may become taxable. It started in 1983 with the Tax Reform Act and established the initial income of $32,000 of taxpayers who are married filing jointly. It's called provisional income. I won't get too far into the calculation, but essentially it made it so up to half your Social Security benefits could become taxable.
Right.
It was later expanded in 1993. So first in the Reagan administration, then under the Clinton administration, and they added a second tier at $44,000 for married filing jointly. That means up to 85% of your benefits may become taxable. And so what we've seen is most people are now paying tax on some portion of their Social Security. If you don't believe me, just go to your tax return, find the line, I don't know if it's 4 or 5A, that has your Social Security benefits, and then look at B, which is going to be the taxable amount. You're going to see, oh, holy hot dog, there is taxes on my Social Security. So. I think it's safe to say majority of people hearing my voice right now don't think that that should be the case, that they shouldn't be paying taxes on that. Now, I want to give another update quick, because we want to do 2.0, right? Right now, we're still having things work, as of this recording, work their way through the Senate. The House has passed a bill. Key note here, during campaign, we heard a lot about no tax on Social Security. That is not part of either of these bills. There's an additional deduction for seniors above age 65 that would take it to maybe $2,000 per person, for a total of $4,000 for a household of additional deduction above the standard deduction. But there is not a provision in the current tax, and there's an easy explanation why. That would take like a more of an act of Congress where they're passing it through a full majority, like 60 votes in the Senate, because they're actually changing the Social Security Act like they did with the Tax Reform Act and the additional law in 1993.
Right, so more to come on that, right?
Yes.
For sure. Well, next up, required minimum distributions. This is another thing that folks don't realize. This is why they are headed into retirement with the tax hangover. Explain those.
Yeah, so a required minimum distribution is, we call them RMD, so we use a lot of
acronyms
in our profession. So the IRS mandates that when you hit a certain age, you are required to start taking money out of your qualified account or tax deferred account, and it doesn't matter if you need the income or not. It doesn't matter if you want to do it, you have to do it, okay? And so it's mandated. So we'll show you a chart, the RMD chart, and you can see if you were born, when you have to take an RMD is based on what year you were born, not your birth date, but what year you were born. So for example, most people that are hearing this who have not started an RMD yet, most likely would be starting at age 73. If you're born anytime after 1960, you can see on the chart that you would start your RMD at age 75.
Right.
So the challenge with that is we're deferring this growth of these accounts, and then now the IRS is saying now you have to start taking it out,
whether you need it or not.
Whether you need it or not, and so that's one of the biggest challenges that people face. And for example, we did this in our last show. I'll use this example again though. But if we had an IRA account with $750,000 in there, and we're 73 years old, that would be a $28,301.89 RMD. So that's money that I have to take out. I'm going to add that to my Social Security, to any other investment income that we might have. And so you can see how that could be a problem and push you into a higher tax bracket.
Right, for sure. Yep. And then you have the taxable accounts, right? Investment income. So we got to touch on those briefly too.
Yeah, so if we want to pull our tax buckets up real quick, I want to make sure people understand what we're talking about here. So we got 3 different tax buckets. We got taxable, tax deferred, and tax free. And in a rising tax rate environment, there's a mathematically ideal balance to have in those first 2 buckets. Any surplus needs to be shifted to the tax free bucket. You want to do that in a responsible fashion. Now let's assume you've got some money in that taxable bucket. That means that it's like 1099 always. You're always going to get a form from the custodian or the bank or wherever it's held. And so like where we see this, Kristen, is we see a lot of people who they've got $250,000, $500,000 in money market or bank CDs, and they feel pretty good because, that's kicking off, $20,000, $25,000 in interest. It's like, oh, look how good I'm doing. And it's not money they're using. It could be a lost opportunity. Maybe one of the spouses is still working, and so they've got earned income, and the income's below $236,000, so they'd be eligible for a Roth IRA contribution. We could start moving at least $8,000 a year per person, $16,000 for a household, into a Roth to make that from taxed always to tax never, right? So the taxable bucket, it's the least effective place to grow wealth. And I'll end this segment with an example of why that's the case. So there's something called a phantom gain that you can get inside of a taxable bucket. So asset location is kind of part of this story, what investment you own and what account. Well, let's just say you own a mutual fund like my client Mark did inside of his trust account, which is a taxable account because it's a revocable trust. In 2023, the capital gain distribution that this fund kicked off, not something he sold, it's nothing he did, it's the fund itself sold some stocks. They paid the gain, essentially, they passed it on to him. It was $20,000. So when we were doing tax planning for 2024, I built in a $20,000 buffer to assume that there was maybe $40,000 that would be a capital gain distribution. So that way when we were doing our Roth conversions, we had a little bit more flexibility to not go over what's called an income-related monthly adjustment amount for Medicare. It's a surcharge we can talk about next segment. The actual 2024 capital gain distribution, you ready for it? $64,000.
Wow.
Just 1 year prior, it was $20,000. So you have a lack of control. So this taxable bucket, you have to be really careful. That's why you don't want to place the responsibility of your tax plan in the hands of just anybody. You want to make sure it's a seasoned veteran, somebody who's experienced, knows what they're doing, has walked this path before, and I've got good news for you today. You're looking at 2 right now, and we've got a whole team behind us that can help you as well. So give the number at the bottom of your screen a call. We're going to set up, we're going to do a tax analysis for you as part of that written financial plan, and you're going to see your taxes in a way you've never seen them before and be able to start making some educated decisions on how to keep more money in your pocket, less out of Washington.
Wonderful. Tim, Jeremy, thank you so much. To our viewers at home, that number to call to claim your complimentary written financial plan, and as Tim said, as part of that, you'll get that comprehensive tax analysis for yourself as well, is 866-256-7778. Or if you'd rather connect online, simply scan that QR code, and that will get you connected as well. Don't go anywhere. When we come back, we're going to continue this conversation on how to de-tax your retirement, and don't worry, we've got solutions for you, along with a very powerful resource that will help you see what your potential tax bill might be over the rest of your lifetime. Stay with us.
Our team is very unique, so we all have different gifts. When you put it all together, it fits well.
Jeremy is definitely our most seasoned and fastest growing advisor we have. He's discerning. So he understands the way we want to do things at Stonebridge, to focus on the client and solving their problems, and that's really what he's passionate about.
I know Tim spends a lot of time making sure that all the I's are dotted and T's are crossed for his clients. And he's not just satisfied knowing the 30,000-foot view, he wants to get down in the weeds and know exactly how it works.
The things that you buy, the stocks, the bonds, the mutual funds, that really isn't that important to the client. What's important to the client is, what does this mean for me? And at the end of the day, what it means is they can sit back and listen to the music. You know that you've got a team, not just one person, but an entire team behind you that's taking care of those things, so you can focus on what's important.
Have you ever considered refinancing your retirement? When interest rates are low, you might be able to refinance your home, your car loan, or even credit card rates, because it would help you keep more of your own money each month. Yet when interest rates go up, it may make sense to refinance your retirement. Higher interest rates could provide income opportunities that you may not be aware of. What works for your portfolio during low interest rates may not work for you when interest rates are high. Find out if a retirement refi could work better for you. Give us a call today and schedule a complimentary Refi Your Retirement review.
Welcome back. You're watching The Retirement Compass. I'm Kristen Oakley here with both Tim and Jeremy from Stonebridge Wealth Systems. If you're just tuning in, we are talking today about how to detax your retirement. This is 2.0, if you will. We talked about this a few months back, got a huge response. We know you are hungry for this information on how to remove Washington from your wealth, and that's what we are talking about today. So just like any good detox plan, you need to have a plan in place. You need to have a plan in place to detax and remove these harmful taxes from your retirement. That's what we're going to talk about now. Before the break, I mentioned we're going to share some solutions along with an awesome resource that you have created. Can you share with our viewers what that is?
Yeah, so like any time that you're going to detox, you got to know what you're detoxing from, right? And that's what this tool that we created, it's called Stonebridge. If you go to stonebridgetaxbill.com, that's the website that you'll actually go to. If you go there, you can actually start inputting information. And what we're doing is we're actually assessing what's going on from a tax assessment. You know, just kind of like you go to the doctor, you get a health assessment. So that's what we're doing. We're getting that assessment. And so if you go to the stonebridgetaxbill.com, you're going to see what you input your accounts.
Yeah, well, let's just walk them through it, shall we?
Go ahead.
Yeah, for sure, because this will be really helpful. If you're at home, we know your smartphone is sitting right there. Go ahead, pick it up, go to stonebridgetaxbill.com or click on that QR code, and here is what you're going to see. There's going to be a landing page where you're going to input some basic information, your name, your current age, because this will actually calculate for you your potential tax bill throughout the rest of your life. So the software needs to know where we're starting from here. You're going to put in your email address where you'll receive a complimentary 4-page report, and then you're going to put in how much money you have saved up in tax-deferred accounts. For you, it could be a traditional 401k, 403b, something like a traditional IRA. You'll notice there's 2 little sliders there at the bottom that you can play around with. You can adjust your assumed tax liability along with the assumed growth rate on that tax-deferred bucket of money. Then, once you click submit, 2 things are going to happen. Instantly, side by side, you're going to see the difference between the government's tax plan for you there on the left if you do nothing versus how much less you could pay in tax there on the right-hand side of your screen. But that's not all. Then you're also going to receive a complimentary 4-page report emailed to you. This is a screenshot of 1 page of that report, which will show you the breakdown of your numbers. And again, it is staggering when you look at the difference between how much tax you might have to pay versus how much less you could have to pay there on the right. I mean, this is why your phone went crazy once we talked about this in that previous show, right, Jeremy?
Yeah, absolutely. Yeah, it was awesome.
Yeah, and what I like to call this is your mandatory versus your optional tax bill, right? So if you think about that on the right-hand side, that was your mandatory tax bill. I can't change that. You're going, using strategies like Roth conversions, it's not about tax evasion. That's illegal, okay?
Right, yes,
and
that's not what we're talking about.
Minimization.
Yes.
And so it's, hey, I have this mandatory bill, I've got to pay. Now, I get to choose whether I pay the mandatory amount or I voluntarily choose to pay the optional additional amount.
Right.
Now, if it's up to me, like that was, I can't remember the dollar amount we used as far as the basis, if you will.
If we put it back up, we'll show you there. I think it was a 500 or 400,000. 400,000.
We've had people coming from the show that called in that had like 2.4 million. If you want to see some crazy numbers, if they retain their plan and use the optional, they might pay $4 or $5 million in taxes between what they'd pay on their RMDs, what they'd pay on the reinvested taxable account I told you that is an inefficient place to grow wealth, and what their children would then pay because the Secure Act condensing down, compressing your distribution from a stretch IRA, that's gone, that was killed in the Secure Act, to just a 10-year distribution pattern. It's insane the amount of money that people would potentially have to pay on a qualified account. This tool is a starting point, and then we get the solutions that are really fun, which is how to fix it. Exactly,
because I was going to say, it's I think mind-blowing for folks to realize I might have to pay more in tax than what was actually originally in the account, right? Because the account doesn't stop growing. And I think that's the challenge for folks to understand, but awareness is the first step. Really, that's just the first step. The best thing someone can do is actually come in and sit down with you guys, right? And figure out the solutions.
Absolutely, yeah. Yeah, I mean, if you're wondering about what does this look like, and you get that report, when you look at the report, it might look like it's just a bunch of numbers. There's some glaring ones that pop up, right, that you're going to see right away. But what you need to do is take that follow-up step and actually call our office and sit down and meet with the advisors who are trained to analyze the report that you got and look at your situation and then help assess and determine the best way to detox your tax situation.
Yeah, for sure. Because it's not like the IRS is going to say, hey, just so you know, you could pay less. Here's how you do it. They're not going to do that for you, right? That's what you guys do for folks. And again, we don't want you to pay any more to the IRS than you are legally required to pay. So in addition to visiting stonebridgetaxbill.com and getting that complimentary report, that's really just the first step. The best thing you can do is then come in and sit down with the team of Stonebridge Wealth Systems and help see what solutions are available for you to detax your retirement. That number to call to set up your complimentary written financial plan is 866-256-7778. Or again, you're welcome to scan that QR code and that will get you connected as well. Don't go anywhere. When we come back, Tim and Jeremy are going to share a real life example of someone who was blown away by what they saw from this tax calculator and what solutions they were able to enact for them to help them detax their retirement. Stay with us. We'll be back.
Have you ever taken your family out to dinner and been shocked at how expensive the tax bill was? Well, guess what? Right now in the United States, there are around $37 trillion in tax-qualified retirement accounts like pensions, 401ks, and IRAs, and the vast majority of those dollars have never been taxed. Hi, I'm Jeremy Gove, partner and financial advisor at Stonebridge Wealth Systems, and I want to take a moment today to have you think about how much money you have saved in tax-deferred retirement accounts. Did you know that not all of that money is yours? That's right. When you put money into an IRA or 401k, that is like going into partnership with the IRS. At Stonebridge Wealth Systems, we have created a free online tax calculator to show you what you could pay in future taxes on your retirement accounts. Go to stonebridgetaxbill.com or scan the QR code below. That's stonebridgetaxbill.com.
Have you ever considered refinancing your retirement? When interest rates are low, you might be able to refinance your home, your car, and even your credit card rates because it could help keep more of your money each month. Yet when interest rates go up, it may make sense to refinance your retirement. Higher interest rates could provide income opportunities that you may not be aware of. What works for your portfolio during low interest rates may not work for you when interest rates are high. Find out if a retirement refi could work better for you. Give us a call today and schedule a complimentary Refi Your Retirement review.
Welcome back to the Retirement Compass, where today we've been discussing how to detax your retirement. If you are just tuning in and joining us, please do yourself this favor. Do not miss the opportunity to go use this complimentary resource, stonebridgetaxbill.com. You can access it by going to that web address or by clicking that QR code. It will show you in a matter of minutes what your potential tax bill might be over your lifetime, but we don't leave you hanging there with that depressing news. Right? It also shows you how much less you could pay in tax if you enact some of the tax saving strategies that the team of Stonebridge Wealth Systems enacts for their clients each and every day. We want to share a real world example.
Yeah.
I know we talked at the beginning of the show why taxation in retirement can get more complicated.
Yeah.
So I would love for you to share this example of a couple that you worked through this with on how to detax their retirement.
Yeah, and just how complex it can be and not as intuitive as you would think. So I put together an example, and I've renamed them Sam and Sandy Sample.
Yes, we like to.
That is a sample name.
We like to protect the innocent, right?
Yeah, that's right. So I'm going to pull up, we've actually put some graphics together that's going to help. So let's talk about the snowball effect. This is where you start combining things like Social Security with RMDs and capital gains and how it all works together. So effectively, we're looking at my friends Sam and Sandy, and they're retired, age 66, and they live in rural Custer County, Nebraska here, cattle country. They have everything paid off, no debt, and live comfortably on $55,000 per year. Now, Sam decides he is going to start digging into the retirement and tax situation, since he's pleasantly surprised they've owed no tax whatsoever since they retired last year. He does the following calculation and finds that they have a net taxable income after their standard deduction of a negative $16,700. Woo, great.
So that means no tax.
No tax due. No money back, but no tax due.
Right.
Because they didn't pay any tax in, so there's no refund. This is due to the fact that only $1,500 of their $40,000 Social Security is taxable. Sam then decides he wants to utilize this deficit and take Sandy on a nice European vacation. What a guy this Sam is.
Yes,
I mean, come on.
It's great.
And he books the tickets, makes the payments, and the total comes out to exactly $16,700. This guy should be an accountant, right at $16,700.
Good with the calculator.
Sam, well done. However, where did Sam get the money for the tickets to pay off the credit card? Well, his IRA, of course. He had an extra $16,700 of runway before paying taxes, right? As Lee Corso may have said back in the day. Not so fast, my friend. There you go, Jeremy. If only it were that easy. So here's what actually happens, and we got it on the right-hand side. You can see it up there. Sam's additional IRA withdrawal of $16,700, that actually causes roughly 66% of $16,700 Social Security dollars to become taxable, which means that total taxable Social Security is now $12,545. That's an $11,045 increase. So while the $16,700 withdrawal is indeed offset by the standard deduction, the additional tax on Social Security of $11,045 is not, resulting in an unexpected tax bill of $1,105. Now that might not make a lot of people too concerned or give you heartburn, but the point remains that it's not quite as clear-cut as you would otherwise think, which is why, again, it's important to have somebody who's familiar with this territory to navigate safely.
Well, and in a lot of cases, folks have other ways that they could have paid for that trip if they had the right withdrawal strategy in place to help them have a tax-efficient retirement.
Well, like, let's take a portion of it from your IRA up to what would cause basically a complete offset between taxability on Social Security and your IRA distribution, and take the rest from maybe you've got a brokerage account or a Roth IRA because you already did these conversions. There's a lot of different solutions that could have been implemented. What do they say? An ounce of prevention's worth a pound of cure?
Absolutely.
Because you can't undo this, unfortunately.
Right, and that's the thing, is awareness is the key, and this is why folks need to understand that they are headed into retirement with that potential tax hangover. But again, the good news is you don't have to stay there. There are solutions in place. What do you want to leave with our viewers with on this important conversation as we wrap up Detaxing Your Retirement 2.0?
Yeah. You got anything, Jeremy?
Go ahead, Tim.
I would say the way I see it, there's three different ways you could go about this, okay? Number one is you could just keep going the way you're going as a passenger in life and say, I'll worry about it. They'll pass some tax bill and I'll just deal with it whatever comes at me, I guess, that come what may. Probably not a great way. The other way is you can do it all yourself and become kind of a master of this trade. Number three is you can find someone who already knows how to do it. And I like to think that our team of experienced advisors is well suited for that job. We hope to talk to you soon when you give us a call.
Yes, well guys, buckle up, get ready for the phone to be ringing. I know a lot of folks after visiting StonebridgeTaxbill.com are gonna want your expertise and help. And again, you can reach out by calling 866-256-7778. Thank you so much for watching. Be safe, be happy, be blessed. And we look forward to being back with you next time here on the Retirement Compass.